Hello and welcome to our channel. Today we're diving into a critical issue that could have a devastating impact on your financial future. We'll break down what a yield curve is, what an inverted yield curve means, and why it signals severe economic trouble ahead. We'll also review historical market crashes and discuss how you can protect your wealth with gold and silver. Pay close attention, this could save you from financial ruin. What is a yield curve? A yield curve is a graph that shows the relationship between interest rates of bonds with different maturity dates. Think of bonds as loans you give to the government or corporations. These loans pay you back with interest over time. In a healthy economy, short-term bonds like those maturing in 2 years have lower interest rates compared to long-term bonds, like those maturing in 10 years. This makes sense because investors expect higher returns for the risk of tying up their money for longer periods. Sometimes, short-term bonds pay more interest than long-term bonds. This happens when investors are terrified about the future and prefer to invest in long-term bonds. This unusual scenario is called an inverted yield curve. The dire reality of an inverted yield curve. An inverted yield curve is not just a subtle warning, it's a glaring red light that a recession is imminent. Historically, every major recession has been preceded by an inverted yield curve. This isn't a matter of if, but when. The inversion of the yield curve is a definitive predictor of a looming recession, and it brings with it severe economic fallout. Key historical examples. Let's look at a few key historical examples that should make you sit up and take notice. First, the 2001 recession. The yield curve was inverted for about 300 days. The stock market crashed by 49% during the dot-com bust. Then the 2007 to 2009 recession. The yield curve was inverted for about 540 days. The stock market plummeted by 57% during the financial crisis. And it's not just these two instances. Every major recession, including those in 1969 to 1970, 1973 to 1975, 1980, 1981 to 1982, and 1990 to 1991, was preceded by an inverted yield curve, leading to significant market downturns. The 1929 parallel, a dire warning. In 1929, the yield curve stayed inverted for an extended period, leading to the Great Depression. The stock market lost nearly 90% of its value. Today we are experiencing an inverted yield curve that has lasted over 700 days, a scenario only seen once before, in 1929. This is not a coincidence, but a clear signal of impending economic catastrophe. Do you really want to take the same risk that led to the most devastating market crash in history? Current economic indicators, the calm before the storm. Right now we are witnessing massive layoffs and rising jobless claims. Historically, these signs, along with an inverted yield curve, have always preceded a recession. The stock market might still be climbing, giving a false sense of security, but this is the calm before the storm. The market often remains disconnected from the real economy, continuing to rise until it suddenly recognizes the underlying economic reality. The longer this disconnection lasts, the harder and faster the market will crash once it catches up. As layoffs continue to accelerate, the greater the chance of a market crash. Before a major market crash, corporate insiders often start dumping their stocks. These insiders, with their deep understanding of their companies and the economy, act on early warning signs that the market is about to turn. Right now, corporate insiders are dumping their stocks. Their actions should be a clear signal to everyone else. If the current inverted yield curve follows historical patterns, we are on the brink of a severe market crash. The numbers don't lie. The 2008 financial crisis saw the market drop 57%, devastating countless portfolios. The 1929 crash resulted in the market losing nearly 90%, wiping out wealth and causing widespread economic hardship. Imagine waking up to find that half of your life savings have evaporated overnight. That's the kind of devastation we're talking about. In times of financial turmoil, gold and silver have always been safe havens. Here's how they performed during past crises. During the 2008 financial crisis, gold prices surged from $800 per ounce in 2007 to nearly $1,900 per ounce by 2011, an increase of over 130%. Silver prices skyrocketed from $15 per ounce to nearly $50 per ounce during the same period, marking a rise of over 200%. Physical gold and silver offer unmatched privacy compared to digital or paper assets. They provide robust protection against economic instability and inflation. Gold and silver have maintained their value over time, preserving wealth during economic downturns. You don't have to be an expert on yield curves to understand the gravity of the situation. History has shown us that when yield curves steepen, chaos is just around the corner. The yield curve is getting closer to uninverting, which will be the signal that things are about to get really bad very soon. Based on historical data, it's now time to be proactive and not reactive. This financial storm is coming, and there's nothing stopping it. Your stockbroker or financial advisor will never tell you any of this. They also won't tell you that you don't truly own your stocks. You are merely the beneficiary owner. In a crisis, they have control, and they can freeze you out of your account. This is a great convergence of everything happening at once, and they are absolutely 100% navigating these financial waters blindfolded. You are going to drown in paper assets. Stick with something that has a track record of thousands of years. Gold and silver have never gone to zero. They have no counterparty risk and no one else's liability. For the future, you need to protect, preserve, and privatize your wealth with physical metals. The choice is yours. Lose potentially the majority of what you worked hard to create for yourself, or get under the financial shelter of physical gold and silver and have peace of mind. As the saying goes, those who do not learn from history are doomed to repeat it. History may not always repeat itself, but it certainly rhymes. The current economic indicators are not just warning signs, they are clear signals of an imminent financial disaster. Ignoring these signs can lead to devastating losses. Investing in physical gold and silver now can safeguard your wealth and secure your financial future. Remember, the longer the yield curve stays inverted, the deeper the market crash will be. If the market can crash up to nearly 90% like it did in 1929, do you really want to take that risk? Swiss America has been in business for over 4 decades, helping clients navigate through economic turmoil and secure their financial futures with the stability of gold and silver. Our expertise and dedication to safeguarding your wealth make us the trusted partner you need in these uncertain times. If you still don't understand what's getting ready to happen, please give us a call at 1-800-289-2646. This is a no-obligation, just educational conversation we will have so you can completely understand what is getting ready to happen and how you can protect, preserve, and privatize your wealth. Don't wait until it's too late. Contact us today to protect your assets and ensure your financial security with the timeless stability of gold and silver. The storm is coming. Act now to weather it safely.